Hello and thank you for joining us on this Ugly Duck 2020 podcast, an EIF podcast for our venture capital GP community. I'm Daragh Brown, Head of Marketing at the EIF, and joining me today is my colleague Uli Grabenwarter, Head of VC Investments. Over the last 20 years, we've been backing new and established teams across Europe to nurture and develop the ecosystem. On an annual basis, we get together for a VC conference called the Ugly Duck to provide market insights and take stock of the year that's passed. Unfortunately, this year we weren't able to host Ugly Duck 2020, but we wanted to take the occasion to sit down with Uli and discuss the current market dynamics in European VC, particularly in the context of COVID-19. But before we begin, I wanted to remind our listeners that none of the information contained in this podcast constitutes investment advice, a solicitation by the EIF or its affiliates to promote, buy or sell any financial products or services, securities, futures, options or other financial instruments, or to participate in any other strategy. Enjoy the show. So welcome Uli, good to talk with you. Thanks for joining us on Ugly Duck, a special Ugly Duck 2020. Before we get into it and look at the VC market, give us your own perspective of COVID. How's it gone for you and your team? I mean, how is even the work going? How's the due diligence happening? How has this remote environment been for you?
Yeah, first, great being with you, Daragh. Great having this opportunity to chat in a more casual context about the market situation. Well, the situation that we have been through in 2020 is obviously beyond any comparison to the past. We had basically to reshuffle our entire business approach over the last 10 months, and that has been quite demanding for the entire investment team, I have to say, because we are in a people business. That means that the interaction with our counterparts, with our GPs that we're investing in, is so important, is so essential in our investment approach that being confined to basically an interaction with GPs that only works through computer screens and Skype screens and what have you has been a big challenge. And we needed to adapt because in the beginning we were trying to push due diligences out and say this is going to go by very quickly and we are going to be back to normal. And as we moved forward, we just understood that this is not going to be normal anytime soon, and we needed to find our ways through adaptations of our processes that we could continue business.
Yeah, no, and I think, my observation has been that for everyone in the EIF, we feel like we're working at full steam. In fact, probably more busier now than we've ever been, and I think that's a testament to the colleagues. Okay, so let's dive in. 2019, you showed us some impressive performance, results that some funds hitting IRRs of 370 odd %. I think the 50th rank fund was at 20%. So what are you going to tell us this year? And are we seeing those same impressive results given what we now know in terms of the pandemic?
Yes, obviously anything that I'm going to say where we stand in this industry today has a big caveat, which is that in the industry we know that the information on our underlying portfolios come in with a certain delay because we have got a time lag of 3 to 5 months in terms of the information as it filters through from the reporting from portfolio companies to funds, and then from funds to us as a fund-of-fund investor. But if we look at it from the perspective of before the impact of the COVID crisis became apparent, and that's the comparison that we can draw from the results that are now in from the first and second quarter of this year. We can say that the industry has been holding up quite well. Actually, it has been holding up surprisingly well. True, we do not have the same increases in IRR figures as we've been experiencing in the previous years, where we have been going in our top performing funds in the portfolio from 20 to 50%, and then from 50 to 300, and then to 360 or what had we. If we look at the performance figures and the distribution of return figures this year, we realize that they are roughly at the same level as what we've seen last year. certainly we did not have the same increase, the same evolution anymore compared to the previous years that we saw every year a step up in the performance figures. But we also didn't see any decline. So what we can say from that is that we see the venture capital industry having in 2019 and beginning of 2020 consolidated in IRR terms at a very high level that we have been sharing already last year. There's virtually no statistically relevant difference in the performance if we take it at the picture that is reflected in Q1 figures of 2020.
Just to add on that then, I seem to remember last year we kind of always like to show the comparison between ICT and life sciences. Last year, life sciences had a lead, let's say, or was the top performing fund. How does that look in 2020 based on your data?
Yes, that's always a funny comparison, because I know that the industry is kind of competing in this, and I have got a personal stake in this because I'm a passionate life science investor myself. So I'm sharing this type of information not without certain personal pressure, but yes, I can confirm also in 2020 life sciences has the lead.
Okay, good to know. I know many of our audiences always ask that question. Okay, so you know, to quote you, we're surprisingly holding up well. You have said, certainly last year, and many times I've heard you say this, that the VC is a counterintuitive hedge, particularly in time of market crisis or market crash. Do you still stand by that statement, given where we are?
Probably more than ever, Daragh. And I know when I made this statement last year at Ugly Duck, people were scratching their head quite a bit, because we have made a very long journey with venture capital, coming from almost the perception of being a charity business 2 decades ago to something that could basically fight its way into asset allocations in institutional investment portfolios. And last year I said that if you're looking at venture capital as an asset class, as a diversifying asset class in your asset allocation, we are today in an environment where the business models that are put forward by venture capital-backed companies are basically offsetting or even outpacing traditional business that you may have in your portfolio. And if we look at the reaction of the venture capital market space to the crisis of COVID-19, and even if you look at the big hit at the stock markets in March, the market segments that came out first in terms of valuation corrections from the crisis, those market segments that recovered first from the big dive that the stock markets have taken have been the technology markets. And if we look at it from the perspective of our own portfolio and take this off the visibility of stock markets perspectives, and we look at it from our own assets in venture capital and private equity, we need to realize that the venture capital portfolio has been resisting better to the downwards trend and has been recovering quicker and more completely than the private equity portfolio. So if you look at it from today's perspective, in comparison to our mid-market portfolio, venture capital has made up for more than the correction that we have seen in Q2. And we're basically trading in positive territory performance-wise compared to what we have had in the first half of this year, while the mid-market private equity portfolio is still lagging behind the valuations that we've seen in the beginning of the year. And
we've talked about in the past, you and I have actually talked about this privately, the valuations. Valuations are up. The valuations, are they realistic? There's been commentary certainly on the US in the private markets that valuations seem to be fairly optimistic. In Europe, do we suffer from that problem, or the valuations, to the best they can be, are realistic?
Well, actually, realistic and today's market environment, no matter where you look, is a very hard comparison to make because we are so swamped with liquidity in any segment of the financial markets that we're probably overvalued in no matter what circumstances that you're looking at. But if you make the comparison between the US market and the European market and look at where do we stand in terms of valuation data points, there has historically always been a valuation lag between Europe and the US, where the US market has been running ahead the European valuations by quite a margin, and that continues to be the case, and that is driven by the much higher affinity with the venture capital asset space in the US than in Europe, and also the massive amount, the supply of money that is available to back that. So we continue to have this valuation lag, and from that perspective, Europe being more attractive from a valuation point of view. But this being said, also the European market has not seen a correction in the valuations. Otherwise, we would not have seen the recovery of the market that I was referring to before happening in a European context. So valuations in Europe continue to be up. Financing rounds at very high valuations in very specific market segments with high profile companies continue to happen at very high valuations, and also exits, even exits in the stock markets would suggest that the valuation levels are not corrected massively. It's just probably more selective which companies manage to get to the market and get to an exit because the selectivity of buyers has increased.
Okay, so I'm paraphrasing a little bit, but so valuations are up, VCs outperforming other asset classes. I mean, from where I'm standing, are we insinuating or saying that COVID's had no impact at all on the VC industry, and that we just had this little blip and we've recovered? I mean, is that really the case, or could we, let's deep dive a little bit into it and see, okay, let's analyze what's underneath that and what that actually means. What is the actual impact COVID has had?
Well, surprisingly, I've taken the liberty to look at the broader picture and not confine the analysis that I did this year to just the impact of what happened between March 16, when whole Europe went into lockdown, until today. But I've been looking at what dynamics have changed in the market in the period of COVID and just before and basically up to now, and how can we interpret it and project what is going to happen in the future. And there was one surprising element that I was stumbling over when I did a data cut for the year 2019, and actually I took the timeline back to 2015 and was checking how were portfolio valuation corrections happening in our portfolio. What were the levels of write-downs and write-offs that we have in consecutive quarters since 2015 up to today? And they have been fairly stable, but surprisingly, I found out that we had very important peaks in Q4 2019 and Q1 2020. So from the timing perspective, it is obvious that those corrections and those peaks in write-downs and write-offs have not been linked to COVID. We just had the first figures in from China that something is happening there, but definitely not something that could have influenced any valuation in any portfolio anywhere on the globe. And yet we had those peaks, and very massive and very significant peaks in Q4 and Q1 than in 2020. And if we write that forward and look at what happened in Q2, Q3, and now in Q4 2020, we realize that actually those peaks dropped back to normal levels that we've been observing in 2019 and any year before. So if you want to be totally provocative, you could almost say that possibly the venture capital market segment, and as a matter of fact, probably the private equity market segment as well, has not been holding up despite of COVID, but has been holding up because of COVID, because as a result of the economic lockdown that we have been experiencing across Europe and across the globe, as a matter of fact, the public sector has undertaken massive efforts to actually absorb this market shock in one way or the other, and making available massive support programs in financing, in pumping liquidity into the market to make sure that the companies stay liquid, that we can continue guaranteed levels of employment that were just threatened by the situation of the economic standstill that we've been going into. And if you do this type of massive support from the public sector that basically covers entire industries, that covers entire economic sectors, you cannot make it that precise that you actually tailor it to specific types of companies or specific states of health of a company. You undoubtedly also will make that available to companies that may not have been very resistant in the first place. And in doing so, you basically support the industry across the board, probably broader than you would normally have done.
So I want to hold on to the thought about public sector funding, because I think it's a really important subject. It's a subject that, as we know, for us comes up a bit. Just before that, though, analysing or talking about what you've just said, you refer to the peaks in Q4 and Q1 of this year, so pre-COVID. But maybe elaborate on what was happening. Why did we see a peak? I can understand why they've disappeared, but I'm not sure I'm following. Why did we see those peaks, and what is behind that?
Well, I think the observation that we had already last year, and I think I made also a reference in my talk, Ugly Duck 2019, to it. It was undoubted that we have been at peaks in valuations across all asset classes, and including venture capital, and especially the technology sectors have been exposed to a great deal of capital inflow and a great deal of interest from investors. So presumably we had already an issue of selectivity prior to the COVID crisis that would have possibly materialized if COVID had not happened, and would have materialized in a market correction that may have intervened at that point in time, independently of COVID happening or not. And because of the rescue measures that came in to support companies that have been at the edge, well, you can call it putting the law of Darwin into a parenthesis, or you can call it being saved by the bell, but that's roughly what happened.
Okay, so let's stay on that. Okay, two questions, and I can repeat them because they're long-winded, but they are connected. So we have been in the past criticised for injecting too much capital into the market. So too much government-backed or public sector funding going to the VC market. That now is even morphed or extended into an argument that says, well, not only is that not good for the market, it doesn't let the market breathe or grow, but also the market becomes less diversified. It becomes quite a homogeneous market because funds start to look like each other because of the requirements imposed by the governments and public sector funding, such as geographical restrictions and other restrictions that we can discuss another time. So I wanted to tackle that question, and then I wanted to then discuss the element that if we are seeing more defensive strategies, so if we looked at the leisure industry now, you can see from your sectorial analysis that a lot of funding is going in there. So companies that need liquidity are being funded, and that's appropriate, and so they should be. Is there a risk that we will not see the next generation of ideas, the next generation of innovators receive the funding that they need? We can look back in history, and it's repeated often, that from the dot-com bubble and from the financial crisis, some of the biggest champions, the biggest unicorns have emerged from those crises. How do we as a public entity balance that element?
Okay, I think those are two very relevant questions, and let me address them in the same order as you asked them. I think when it comes to the approach of public money and a genuinely and intrinsically private sector industry, as venture capital and private equity is, private equity carries it in the name, so there's nothing to be discussed about that. And I think it is one of the biggest challenges that any policy-driven investor has operating with public money in that space. And EIF, when we actually started our activities in the new era of EIF that started back in 2000, actually in the midst of a crisis, because when I joined EIF in 2000, we just have been writing the investment plan for 2001, and by the time we were done with it, the market wasn't there anymore. So we started again from zero. And our objective from the outset, our firm commitment at that time was that we would intervene in the market only to an extent that we can be catalytic for private sector capital. We found that massively important, because otherwise we would have created an industry that would be entirely dependent on public sector funding, and that cannot be the objective of any policy action that you take. But on top of it, it's mission impossible for the venture capital space, because if you want to have a venture capital market that is big enough to support the European industries that depend on venture capital, there is no way that we can actually mobilize that money from public budgets alone. So we need to actually draw in the capital from the private sector and convince the private sector that this is an asset class that is worthwhile being backed and creates value at the level of the economy, at the level of the investees, but also in the asset allocations of the institutional investors that we want to mobilize. And from that perspective, the approach that EIF has been taking ever since its definition of its strategy back in 2000 was to operate with a very diligent approach to the ratio between public sector money and private sector money, that we were cautious not to swamp the market with capital that was easy to get and possibly distorting valuations, everything that you have. And the other element that we always had in mind is that we wanted to get the market connected to different market segments that have been underserved. And in that vein, we have been introducing our technology transfer activities back in 2010, where we have put an additional effort in connecting fundamental and applied research to commercialization in a European context. So we've brought this, we've basically made this market segment investable in the first place. We also have extended our activities into the business angel co-investment space, basically trying to connect the venture capital space to the pre-institutional investment space, where you don't have the same heavy procedures, but you have got business angels often with an entrepreneurial background that try to bring companies to an institutional investability at a certain point in time. We've been developing the market segment of impact investing, social impact first. We are doing the same thing now in the environmental space. So those are all market segments where we have been basically a lead investor pioneering the investment space even prior to any private sector looking at those market segments. And I think it is one of the major roles that EIF as a public sector investor with a private sector mindset, that is something that we have to play.
But okay, so our development role is fundamental, I agree. But are we saying that once we've developed the market, that there's no longer a need for EIF or for the funding that we inject? Is our job done when we are no longer required to invest in funds? So is that success?
If you ask me personally, yes, that is the remit of any development focused financial institution. We are not there to perpetuate our role in the market. We are there to, if you want to formulate it provocatively, we are there to make ourselves redundant. Have we succeeded in doing that in a European context? Probably not fully, but there are market segments where we actually have deliberately withdrawn from our role that we've played in the past. In 2005, 2006, there wasn't any venture capital fund in Europe that would have actually even had a first closing without the EIF. Where we have sometimes been putting up 30-40% of the total fund size in order to make funds happen. Are we still doing the same thing in the same sectors today? No, we do not. We actually have withdrawn to normal LP stakes in virtually all the traditional venture capital market segments. And in the number of players that in Europe have made it to the Champions League and that can actually access private sector capital to an extent that they even end up being oversubscribed, we actually have withdrawn our engagement and our commitment to those funds in a number of cases purely to the private sector money that we self-manage through our private sector fund of fund activities. So we basically have withdrawn policy money altogether from that, because we are not there to crowd out or to substitute the private sector. We are there to enable it. Now, why do GPs still want EIF in the kind of circle of investors that they have on board? Well, I think it has to do with the quality seal that we provide through our diligent selection process, investment selection process, which is also translated in the performance figures of our portfolio, which I've shared in the beginning, and that has actually attracted the interest from private sector investors that even want to invest through us. And then secondly, venture capital is not a stable industry, and we are just coming out of a major market correction, and we don't know how this is going to influence the approach that institutional investors are taking to the venture capital asset class going forward. But in the venture capital space, you can be exposed very easily to the situation that you have got full house of investors in 1 year, and 2 years later, you are going to beg in the street for getting money. And having stable investors, at least a functioning relationship with an investor like EIF, who is there to be counter-cyclical in a way to the market behavior, is always an asset.
Yeah, I mean, I sometimes think in my 11 years at EIF, I always hear this term counter-cyclical, like, so when the market's doing great, we're not needed. That's not been my experience at all. In fact, very much so, we're no longer counter-cyclical. We seem to be a permanent, necessary fixture. Just on that, just to go to the second question then, let's just talk about innovation and ensuring, if we look at these more defensive strategies, is it at the risk of innovation? Are we going to be able to support the next generation of innovators?
Yeah, I think that's a very important angle to take, and maybe we reconnect a little bit to the questions that you asked previously, where you said, how did the market respond to the COVID crisis, and what did GPs actually do in the market? And the observation that I've made in making the cuts through the investment activity that we've observed in the second and the third quarter of this year, if you look at purely from activity levels, nothing has changed. Markets have been served with very important and very sizable investment amounts from GPs across the board. And even financing rounds that have been reported in the market have been reported at very large scales with very high valuations, as I said before. But what is important to know is that the dynamics that are underlying these overall volumes that we observe have changed. And they've changed in a number of dimensions. First of all, we see an increase in the share of follow-on funding compared to initial financing rounds and initial investments in companies. And that is a response of fund managers wanting to equip their portfolio companies to see it through the winter that is ahead of them. Whether this is a winter of 6 months, 12 months, 18 months, 24 months, we have actually no clue. But we know that the GPs in the market have used the policy tools that have been made available to back companies with additional liquidity to basically bunker money big time in portfolio companies that they see worthwhile being backed, and possibly sometimes also companies that were less worthwhile being backed, but let's not go there. And that has led to a massive increase in follow-on financing rounds compared to the other stage segments that I was referring to. And then it is important to see what type of sectors have been backed. Obviously, it is intuitive that in a crisis where we are hit by a pandemic threat, the health sector and anything that is related to create a greater resilience of our society to health threat is an obvious sectorial exposure that you would expect. The same thing if the entire economy worldwide depends on online interaction, that anything that is linked to communication and information technology would see peaks in investments, and that is the case. But we also see that amongst the sectors that have seen the biggest increase in relative amounts that have been allocated to them, we find also the logistics sector, transportation, and we find hospitality businesses. And if you take a look on how the previous 6 months have been treating any business that was linked to tourism and the like, you wouldn't consider that this is a very intuitive choice to make, that you would pile up money in this type of businesses. And that's a clear it's a clear sign that GPs in company profiles that they thought are worthwhile being backed beyond the perspective of the pandemic crisis need massive amounts of money as defensive investments in order to carry them through this crisis. And that's something that we have seen at a very large scale over the last 6 months. Why am I saying this? Because if you are looking at the use of capital that is made available in the market, the question obviously is is this money pulled from other sources and from other objectives that you pursue that you can not back because you need the money to basically deal with a crisis. And in a way, that is a little bit the risk that the venture capital industry is facing, that we are kind of protecting the existing assets in the portfolio with the means that are available today. We are making a lot of financial instruments from the public sector available to cater for the liquidity shortfall right now in this very moment. We are seeing the behavior of fund managers pulling forward the investments that they have potentially reserved for following investments later in the life of their funds, or potentially also resources that they had initially planned to use to have a greater diversification of the portfolio and look at companies in startups and other innovative companies that they would back in 2021 and 2022. And obviously those defensive measures, they draw capital and they drain this capital and bring it forward to a situation that is today, here and now. And the implication of that is that if you use the money that you intended to use in 6, 12 or 24 months time, if you use it today, well, we all know from our private lives that's money that you can't spend again in 12 months or 24 months time. And that is a little bit the threat that we are seeing, that if we are not careful with the market, and especially since we don't know how the institutional investor community is going to behave with respect to the asset class venture capital, that we will experience a shortfall of funding for the innovative sectors in the years second half 21, possibly 2022, depending on how long this crisis actually lasts.
So what can we do? I mean, the natural question that presumably everyone listening to this will say, okay, so we've identified that could be an issue, but what can we proactively do to ensure both short-term liquidity needs that we know portfolio companies have, but also ensuring that our next generation of innovators get the chance they deserve, but also require?
Well, I think we have been doing three things. First of all, and equally important to the two dimensions that you mentioned, there's a third one that is making sure that the money is spent wisely. Because if all the money is used to basically put the law of Darwin out of order, it's not going to help the industry either. So with the first decision that we took, that we would back with additional funding and with additional flexibility those fund managers that can make proof that they are backing their portfolios in a selective way, that they're going after the business models that require backing because of the circumstances, and not going after business models that require backing because they're bad business models. So that's the first instance. The second one is we have tried to be proactive and helpful in creating tools and means through flexibility in the governance of funds, in the resource allocation within funds, but also by creating additional funding sources to back the liquidity needs of funds in order to step up their liquidity need here and right now. We've had measures from the European Commission in place that allowed us to step up commitments to funds that have been hit by surprise by these circumstances. But we also are working on this Pan-European Guarantee Fund, which is an instrument that is specifically designed to cater for the liquidity shortfall in the market. But we are not applying it only to catering for the liquidity shortfall now. We've also, in the building of the instruments that we make available under this Guarantee Fund facility, we make available capital also for helping fund managers that are currently in the fundraising process to reach their target fund size, even in absence of the anticipated support that they had from the private sector investors. because we do see in the circumstances of the market out there that the private sector investors, institutional investors have paused their investment into the venture capital space. Europe once again has been hit more severely than any other geography in the world, because we do have a institutional investor community in Europe that has less affinity with equity as such, and with venture capital as being perceived as a risk capital asset class even more so. So from that perspective, the remit of EIF is to provide a tool that gives fund managers that are in the fundraising process now the means to reach the target fund size of their endeavors in a way that they can continue the investment activity also beyond saving the portfolios that they have on the books today. And how have we been doing that? Well, we have been trying to be very selective in the definition of our projects, of our products. What we've been basically taking care of is that we would give fund managers the ability to access additional commitments from EIF, but only to the extent that it turns out that the private sector is not providing this type of capital. Meaning that we make our commitment that we normally would do in a context of a fund, and would make a conditional commitment that would become available at the end of the fundraising period of such fund, in the case that the capital, the fundraising from the private sector would not have materialized as anticipated. And that kind of gives the industry a perspective of being sufficiently funded to pursue the backing of innovative companies in Europe, without being spoiled with public sector money, potentially to the extent that we would even crowd out the private sector. That is not our role.
So, being a bit provocative, just a little bit, why would we have not done this 5, maybe even 10 years ago? Why not use that exact approach to potentially not provide funding and have assurances that funding wasn't going when it wasn't needed?
Well, as a matter of fact, in substance, we did. Just that we didn't have to be that careful at that time, because if you've got a market environment where no fund manager manages to close at target size, you don't have to worry so much what happens with the excess capital that goes into a fund. It's fair to say that in Europe, in the venture capital space, probably up to 2014, 2015, there hasn't been a single fund that was oversubscribed. And in those circumstances, it was less of a concern for us when we would need to make our commitment and cut back on our commitments. But this being said, in all the circumstances where we saw that the fundraising traction was picking up and the fund managers actually could afford being less dependent on public sector funding, we have been scaling back our commitments as I've described before. We have been very diligent in tailoring our commitments to the fundraising circumstances of fund managers, and that sometimes had massive implications. There have been funds that we have been backing in one generation with investment tickets in the magnitude of 60 to even 80 or 100 million euros in one fund, and today we are backing with single-digit million amounts.
Okay, no, and I think that's an important perspective to have. That when I think we often get these kind of bigger statements around pouring in like excess funding, but when you break it down and you look at the ticket sizes and you look at the evolution of those ticket sizes, I think it makes for important reading, but also good reading.
But if I can react to that, I think it is very important when you look at the activity of the EIF that you do not judge market presence by the overall investment volume of what we've been putting into the market. We are doing investments in so many more sectors, in so many more specific situations in the market today than 10 or 15 years ago, that the basis of comparison is just not there. We've been, for instance, since 2013, we've been building up an impact investment space across different products, equity and guarantee products and microfinance together, which has been inexistent in 2013. Today, we've got almost 1.2 billion of assets under management in only that segment. We're doing the same thing in the environmental impact space as we speak. I have been referring to the technology transfer investment space, which is something that we didn't have as an asset class 10 years ago. So it may be that you see EIF being with 1.5 billion in the venture space and 3.5 overall investments in the private equity and venture capital space combined. But the underlying dynamics, what type of sectors, what type of situations we are backing are very different today than even 5 years ago.
Yeah. I want to talk about fundraising, which kind of, this leads us nicely into fundraising. But just before we close out the kind of investment dimension, are you, based on your discussions with fund managers, or are you seeing there's a clear lessons learned from COVID? Are we seeing, okay, this pandemic has hit us and therefore fund managers are going to make changes, or substantial changes or minor changes in their approach going forward? Are there key lessons learned from COVID-19?
Well, I think key lessons learned are more underlying to what is our society going to be driven by going forward, and what type of businesses do we need in the future? What type of role is innovation playing going forward? It is undoubted that if we look at the dynamics of how we've been dealing with this pandemic, we cannot say that as a society we've been doing great. If it takes basically the lockdown of a global economy to get control over a virus that has been spreading, we need to ask ourselves the question of what we need to do to get that better sorted next time around. And I think this is something that is filtering into the investment strategies of fund managers. We see many more impact-driven investment strategies coming our way now, a very much bigger consciousness of impact in the business models of underlying companies. And that is something that definitely has changed in the process. Whether this is going to something that is reflecting also in terms of the allocation of assets and in the allocation of funds in the portfolio strategies and the like, this is something that remains to be seen.
But I mean, COVID-19 was a black swan. It's difficult. I mean, we couldn't have preempted to know, we need a vaccine, therefore we need to finance that sector or put more funding in that sector because there's going to be a crisis. So tangibly, how do we approach that? How do we ensure that we're better prepared? If the analysis is that we weren't prepared enough, which is difficult.
Well, I think it's you can say it's black swan. You couldn't foresee it, you couldn't anticipate it. But COVID was a pandemic. So was the plague. The plague happened 750 years ago in Europe, and actually the way how we were dealing with the plague in 750 years ago is roughly the same thing as we did in 2020. And what have we been doing? We've been trying to confine populations. We have been trying to lock down societal contacts, interrupting societal contacts, lock down sectors and the like, in order to contain the threat from the spread of the pandemic. We've been debating amongst us in newspapers, in talk shows, in political debates, whether it is more important to protect privacy on one side and have the protection of public health as a good on the other side. If we actually pause for a second and look at the potential of innovation, we will realize that, as a matter of fact, we don't have to ask ourselves this question of a trade-off. We could have it both if we used innovation and technology in the right way. And that is something which is a kind of appeal to the venture capital industry and all the entrepreneurs in the technology space out there. There is an opportunity for equipping our society with a greater degree of resilience for this type of situations if we just managed to bring the breakthrough technologies that we are working on already through to the market and make it useful and usable for the benefit of society. So
are you potentially arguing that this narrative that the VC industry is supporting disruptive innovation or disruptive changes is diminishing a bit? That it's less disruptive now. That we're not planning out how life can change. We're we're investing for a life that we predict today, but not that it's going to be vastly different.
No, I think it is disruptive by all means, because the big question is, what do we do with the hit that we've taken in 2020? Are we trying to build everything back that we say we are back in February 2020 or December 2019 and COVID never happened and we move on the same way as we did before? Or are we finally realizing that we need to change fundamental things in the way how we do business, but also how we organize our society in order to be more resilient if something like that or anything else of that magnitude hits us again? That is the question that we need to ask us. And that does require that we make a different use of technology, that we organize our supply chains differently, that we organize our digital economy differently. That is linking into the question, how do we react to enable life science companies to work on preventive measures for preserving our health in a crisis of a pandemic, for instance? Are we prepared to have another guess in March of a year 2030 or 2035 or 2025, because we don't know when it is going to happen, and we're going to make a guess on how much time it's going to take to develop the next vaccine that we need? Or are we preparing our industry by combining all the technology that is out there to help accelerate those processes in a more predictable way than what we have today?
Okay, wanted to shift on kind of toward last question in terms of funding. I think you've alluded to the fact that it's been complicated over the coming months, the previous months. How do you see the funding environment for GPs today? And over a horizon of months, maybe even years, what are you seeing, and what have you seen in 2020?
Well, first of all, we've seen what always happens when a financial crisis hits the market. And that is that investors pause and check what's happening and adjust as a function of that.
I think in the last crisis, we saw something like a 53% drop in fundraising.
Yes.
In 2008.
Yeah, and if you look at it from the perspective of the pandemic now, what is surprising is that we don't see the same attitude or the same dynamics in the US market and in the European market. In the US market, you could almost say we are back to the fundraising levels that we've seen in Q3, Q4 2019, while the impact on the European market once again has been much more severe and has been also much more prolonged in its effects. So we don't have in a European context yet the situation where we can say COVID in fundraising terms is behind us. Investors resume with business as usual and are back to normal. That is something that we, unfortunately for the European market, cannot say as yet, and we actually don't know when we will be able to say it. And that is the reason why we have also developed, as I mentioned before, from a European perspective, this type of funding tools that can, in a tailor-made way, react to those market circumstances and hopefully support the market in a way that it has access to the liquidity without seeking to own the market.
Yeah, and I think what's interesting about that particular program in EGF is not only the EIF, it's a partnership with member states. It's an idea of a collectiveness, a European solution, which I think is an attractive nature.
Yes, that's very important, and it's great that you mentioned that, because obviously, as I said before, there have been many initiatives being brought to life over the last 6 to 9 months in order to back innovation, technology, private equity at large, and obviously all those initiatives play together to the same purpose, and only if they are well coordinated and if they're taking into consideration what impact one initiative has next to the other, it can be controlled in a way and managed in a way that the market is supported with what it needs, but not with what it doesn't need.
Yeah, no, absolutely. Okay, Uli, I think last but not least, I just wanted to do 2 last questions for you. let's make this kind of quick fire. So the idea is one-liner responses, or to that extent. 2 questions. How will you remember 2020 in a professional context?
How I will remember 2020 in a professional context? I've been rewriting the investment plan of EIFs 3 times a year.
Yes, it certainly is an ever-evolving market, or evolving set of circumstances. I'm sure many of the colleagues would sympathise with that. Last question. You've got, what's the one element you would like listeners to retain after listening to us? That
we need to use technology and innovation, not to repeat what we are going through today.
Okay, Uli, thank you very much for your time. It was a pleasure having you on, and we very much look forward to seeing you in or at Ugly Duck, hopefully physically in Luxembourg in October 2021.
Thank you, Daragh. It was a pleasure being here with you, and yes, Ugly Duck in life would be so much better.